Hi, everyone. Welcome to the Timing Research Show for February 1st, 2016. My name is David Kosmeter. I'm the creator of Timing Research, and today we're going to be talking about the 123rd weekly report from Timing Research. So if you have not had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can download this or any past report there. I have Dave Landry back from China and on to host the show. So I'll go ahead and turn it over to him.
Thank you, David Kosmeter, and thanks to Timing Research for having me back once again here. Looks like we've got a pretty good lineup here, full lineup too. First up, let's go to you, Dean. Tell us a little bit about yourself and a little bit about FollowMeTrades.com.
Yeah, thanks. It's good to be back on the show. I think this is my fourth
Glad to have you.
Yeah, enjoy this. Yeah, so I'm Dean Jenkins. I'm the founder of FollowMeTrades.com, and we offer a stock picking service. We offer one-on-one coaching and some training materials on options and trading setups. So I primarily use Elliott Wave, Fibonacci levels, Dow theory, and I use the ART Applied Reality trading software on my charts to help me with that analysis. And my mentor, Bennett McDowell from TradersCoach.com, he said he's watching today. So if you're out there, hey Bennett.
Hey Bennett.
Hey Bennett.
You don't know Bennett? I haven't seen Bennett in a few years. That's great. Awesome.
Cool. All right, James Ramelli, let's go to you next. AlphaShark.com. Tell us a little bit about yourself and a little bit about AlphaShark.com.
Sure thing. So my name is James Ramelli. I'm an equities and equity options trader here at AlphaShark and also our head educator. What we do here at AlphaShark is run a live trading room throughout all market hours during regular trading sessions during the day where we actively break down equity options order flow, particularly the order flow that's coming from big institutional players, hedge funds, mutual funds, big investment banks, and prop traders to try and get a better read on where institutional money is pressing their bets in any given day and then using that information to formulate trading strategies of our own. So unusual option activity is our main bread and butter. We also trade a number of other technical strategies along with catalyst event trading ahead of earnings and individual equities that we have a proprietary trading plan for as well. So equity options and individual equities is kind of our wheelhouse, and that's what I spend most of my time trading.
Cool. All right, next up, Jim Kinney of OptionProfessor.com. I think everybody's a veteran of the show today. Jim Kinney, also a veteran of the show. Jim, for those of us who don't know you, tell us a little bit about your trading and tell us a little bit about OptionProfessor.com.
Well, basically, I provide the content for the OptionProfessor.com DVDs, and what Option Professor has done for many, many, many years has offered individual investors and others the ability to learn about the different uses and risks of option trading. And as we've said many times, there's many moving parts in the options, so obviously there's a lot to learn. You go with buy, call, buy, put, and then you can go into covered call writing and different types of strategies which have limited risk, some have unlimited risk, and different ways to use the options for speculation or for hedging, and different two-sided trades like spreads and collars and things like that. So there's a lot to learn, and I've provided the content for Option Professor, who then distributes it as a company to the people who want to learn more about the uses and risks of options. And again, we've been doing this for a long, long time.
Cool. Okay, next up we have John Netto. John just dropped out for a second. I don't know if a squirrel got his nuts caught in the wire between us and him, so I'll go ahead. Oh, there he is. Hey, John, you back?
I'm back, buddy.
Okay. I met John, I don't know, what, 10 years ago in Australia, maybe?
Yeah,
it's been a while.
Oh, 9 we met. We had known each other for almost 15 years total, though. The entire... Hello?
Yeah.
Almost like 15 years, I think, going back to trading markets days in the early 2000s.
That's right.
Too.
That's right.
So,
I forgot about that. Okay. Well, we hung out in Australia, so I seem to remember that more than the prior trading markets days. John, you're a veteran of the show, and you're a flat-out veteran. Is that correct?
Yes, sir.
All right. Well, God bless you. John Netto, the ProteanTrader.com. Tell us a little bit about yourself, for those of us who don't know you, and about the ProteanTrader.com.
Sure. I am a very high-velocity cross-asset class trader, very macro-focused. I look at the markets a little bit different, have a different approach in terms of taking a three-dimensional return per unit of risk approach, and I use the Netto number to measure that. So where most people will look at the market from a nominal performance basis, i.e. the market made 3% today or the stock made 2% today, and then at the institutional level, they'll incorporate volatility adjusted returns like the market made 2%, but at a Sharpe ratio of 0.7. I actually measure the market returns based on their nominal returns relative to their predefined risk budget or their ex-ante risk budget, and their downside volatility to that maximum adverse excursion. So everything I do in the markets incorporates the macro narrative, market positioning, and this return per unit of risk function that is delineated and expressed through the Netto number. So that's kind of that's, and I'm author of a book coming out called The Global Macro Edge, Maximizing Return per Unit of Risk. And
Cool.
I'll more to that later.
Yeah, smart of you to put your name on that. I need to take a page out of your book and John Bollinger's book. I never got around to name. My wife keeps telling me, you got to name something, Dave. So, okay.
The Landry lines. How about that?
The Landry something, Anyway, for those of you who don't know me, I'm Dave Landry of DaveLandry.com. I believe when it comes to markets, you can only predict the short term, but you can stick around longer term if the position moves in your favor. So I believe in predicting the short term, you can take short-term profits and then hopefully hang around for a long, long time and catch a longer-term trend. I'm slotted kind of a swing trader, but again, I'll stay with positions as long as they move in my favor. I have a 21-page report that talks about the methodology and the money management, and that covers pretty much a lot of it, or the most of it, and the rest is just detailed. I do have a trading education service, and I also have I think Dean mentioned earlier. Was it Dean? Dean, you have a stock picking service? Did you mention that, or was that? Okay. Dean said, yeah, like Dean, I also have a stock picking service, and I do weekly webinars, and I'll wrap all that up in a little bit towards the end of the show. But you can find me and more information and download the free reports at DaveLandry.com. John, let's go back to you. Based on any technical fundamental indicators that you want to use, easy for me to say, would you predict that the SP 500 will move higher or lower by Friday's close, and that's Friday, February 5th?
Down, lower.
Down. All right. Rate your, and then on the next question, we'll have you elaborate on that. But rate your confidence in that answer by estimating the probability that you have correctly predicted this market's move.
70%.
70%. All right. Okay. We'll let you flesh that out in a minute. We'll come back to you, Dean. Let's go to you. Same question.
All right. Well, I think it's John, right? I'm with John, man. We're going down. We're going down, and I give that a 65% probability, and I'll work that out on my charts.
Okay.
As well.
Yeah, and by the way, everybody, when we get to the next question, feel free to share your charts. James, let's go to you next.
Yeah.
Same question, up or down and percent correct?
I would agree that we would be heading lower this week. I think that Friday's move was just absolutely massively overdone. I was shocked on Friday, to be honest, when we didn't fade at all into the close. I was, I didn't really set myself up for a move like that, but fully expected there to be some kind of move lower into the close on Friday, and we actually didn't get it. We closed on the highs. So then when we come in today after closing on the highs on Friday and don't see any follow-through, I think it's going to be pretty tough for the market to rally throughout the rest of the week. At least that's what market participants would kind of be pointing to based on today's price action. We think that we're probably going to see about 35 points worth of movement this week. That's what the options market is pricing in. So I'd have a downside target in the 1890, 1885-ish area with about 65% confidence that we get there.
Okay, cool. Yeah, I'm glad you brought up some of those points. I agree with some of those things, especially it's always interesting. Everybody and their brother has to buy, and the next day it's like, So, all right, Jim, you're up next. Up or down, and percent that you have guessed that correctly.
All right. Well, again, everybody is just taking a guess here, and a lot of stuff we talk about may be factored into the market. We don't know. But I like to look a little bit at parameters here, and we went from about 2101 on the S&P down to 1812. 50% jump back is about somewhat near the area where we jump back, and so now it's starting to roll over. Two key points right now, 1920 I think is kind of key, and so is 1940. So right now I would say it looks like it wants to take out the 1920 and go down towards 1900, and I would say that's probably at least a 60%. Above 1940, then the rebound rally could be more significant. and so that would be kind of a parameter look at it. But like everybody else right now, it does look like it's had its throwback rally, and it looks like it's trying to deteriorate a little bit right now.
Yeah, what's scary is we're all in agreement this week, and
Unless
obviously
1940 gets up, and then we're not in agreement.
Okay, well, we need somebody. We need somebody to be a contrarian, but it's not going to be me this week. I just have to believe in what I see.
We need some Landry lines in the sand. That's what we need.
Some Landry lines in the sand. Yeah, people always ask me exactly when you get bullish, and I don't know. It'd have to make all-time highs, and then certainly as a trend follower, be bullish. Right now, it's not looking too good. I'm going to share my charts here in a few minutes and show you a couple things that I'm seeing. But the bottom line is, as I think everybody has pointed out, and Jim was the last one to point out, we've been at a pretty serious slide, and so far it just looks like a little bit of a pullback here. And internally, things are pretty ugly, and I'll flesh some of that out in just a few minutes. But I'm going to go with down, and maybe a little bit less sure than everyone, just because we're still oversold somewhat longer term, but I'll go with 55% that we had lower. John, let's go back to you. What developing events are you watching this week that might have a positive or negative impact on the S&P 500 or any other U.S. markets?
Yeah, Iowa caucus is for sure tonight. The Sanders, there's an incredible political premium, uncertainty premium put in the markets right now. And the idea that if Sanders gets a lot of headway over Clinton, the market's okay with the Clinton or a Bush presidency, but obviously, or even if Marco Rubio can assert himself as the number 3 choice behind Cruz and Trump and the Iowa caucus on the Republican side, what scares the heck out of the market is if Sanders closes within 5% of Hillary Clinton in terms of the delegates that come out of Iowa, and he's obviously looking like he's going to absolutely just crush her in New Hampshire, and that presents a real uncertainty premium. So if Sanders finishes even less than 5%, much less, heaven help the market if he wins, we'll be at that lower point that James just mentioned on the strata level, down 35 points lower tomorrow morning. Forget Friday. We'll be down there tomorrow morning, just given those political dynamics and what that means to all the political interests and how the market will factor that in.
Do you actually try to factor the news to your trading, John, or you just kind of?
Absolutely. I trade the macro narrative, and more important than factoring that in is how is the market positioned for that? And so how is sentiment determining where this is? If the market's concerned about something, you have to be aware of those catalysts, because those catalysts are what take you out of your technical regime that you're in. If you look for certain setups and there's a news event that can alter the price action or alter the preceding price action or negate that preceding price action, it can undo an entire technical system. So for me, if you have to know those macro drivers and have to be aware of what can cause a repricing, and the Iowa results can cause a repricing in the markets.
Mark Douglas once said, all it takes is one a-hole to screw up a perfectly good trade. So,
yeah, absolutely.
All right, Dean, let's go to you. What developing events, so they can be technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, let me bring up a chart.
All right.
I feel like a guy without his crutch if I'm talking about markets and I don't have a chart in front of me. So can you see this now?
Yeah.
Okay. Someone used the word guess earlier, and I guess my response would be, my approach, I'm doing my very best to make a grounded assessment on the realities of the price action, and I'm making a probability judgment. So I don't like the word guess. I'm making an informed, probabilistic decision here. Okay, so when I'm looking here at the S&P futures, the E-mini 60-minute contract right now, and what I see here is a really clear Elliott wave structure, and I see, back in early December, wave 1, 2, that big move we had down from the end of the year into January was a super clear wave 3 on this time frame, and then the move up, and particularly last Friday, right into a perfect Elliott wave 4 retracement zone, right where we expect it to go. And we're beginning to see evidence of now it turning around, heading down into a wave 5, which would take us down on the S&P between 1766 and 1662. One of the things people either criticize or poke fun at Elliott is that Elliotticians notoriously never agree on wave counts. But one of the things that I teach, and my mentor Bennett McDowell teaches, is a very simplistic view using modern software tools to analyze Elliott wave. And I'm sure he would have the waves marked exactly the same place on this chart, and so would our students. So we use a very repeatable, very simple method. And again, the move down into wave 5 isn't confirmed yet, but it's highly probable. Right? That's how I gave it a 65% chance going down this week. If we had clear evidence of this wave starting with, a lower low, lower high, and a new low going down, I'd be up around 90% on it, and we'll see how that plays out. But again, I'm at 65% just based on this Elliott wave count, and it's been super accurate over time.
Gotcha. I'm not a big fan of Elliott, but the people who seem to be successful with it use some sort of indicators on top of it so they don't have to spend all their time arguing in forums with each other. And they just go out and trade. James, let's go to you next. What developing events, technical fundamental, will you be watching out for the rest of the week that might have a positive, negative impact on the S&P 500 or the U.S. markets?
I think it's really interesting that nobody mentioned the jobs number on Friday, but I totally understand why, because I, for one, don't really think that it's going to matter too much this week. Like I said before, we're pricing 35 handles worth of movement into the S&P futures this week, and given the volatility that we've had recently and that we have the jobs number this week, I think that's actually pretty cheap. So what that tells me is that the market is probably not that concerned with the jobs number on Friday, not really expecting too many chances for an outsized move on that data point, and that's the biggest macro data point that we have this week. One thing that I'm focusing on is kind of more of a micro view on things, and one thing that I think might actually have a effect on the market, or particularly tech sector stocks, is we have Google earnings this week, and we have a bunch of other earnings coming out too. So what I've tended to do so far this year is focus less on kind of overall macro trends, because I think they've been very difficult to read. And any given day we can come in and see Shanghai shed another 8%, and it's not like those moves have really been telegraphed much at all. So it's kind of difficult to get a read on the U.S. market when what seems to be the main driver of intraday price action, or at least day-to-day price action, is overseas headlines and movements in markets overseas. So what I've done is focus on individual equities that are reporting earnings, because I think it's a lot cleaner way to trade now. So if I'm bullish this week, I'm going to look for bullish earning setups and get long those names, because those catalysts, I think, are a lot more easy to predict and a lot easier to read. So I think that the jobs number on Friday is not that important. What we're going to be concerned about this week in terms of the S&P and broader markets is technical levels. And the open on Friday, I think, is going to be a huge area for stops to be sitting, and that's in the S&P futures about 1875, 1876. So if we break that to the downside, I think we could really easily fall quite a bit more. But with that being said, I think that the macro data points being released this week probably not that important.
Okay. Jim, let's go to you next. What developed? Well, you know the question.
Yeah, a couple of things already happened, and one was the announcement of the consumer spending and the savings rate. Looks to me like obviously people are sitting on their wallet a little bit, and the saving rate is jumping because the boomers certainly aren't spending like they used to, and the guys coming in from back, the other generations behind the boomers, just don't seem to be that spend crazy. So 2/3 of economic growth obviously is consumer spending, and numbers that they just came out with today certainly don't add a lot of confidence there. Two is oil and China. China went from 5,100 and change down to around 3,000 or so, bounced back up towards 35, 3,700. Now we're trading 2,700. So we passed the 40% drop, and now are we on our way to the 60% drop? That's something to keep an eye on. And then oil, obviously losing $2 a barrel today. Was that a dead cat bounce that we just saw? And are we going back into the soup? Obviously, that's pretty important. And then one last thing would be the levels on the S&P. 1940, 1920 is a tight window. If we break the 1920, do we go down to 1900 and then break under 1900? That would add credence to obviously the idea that the bounce back rally is over and a more dramatic wave to the downside might start. The only thing I'm concerned about is if we get above 1940, I'd respect the concept that we might go a little bit further up in the next month or so as the 401k money and the IRA money possibly offset some of this negative vibe out there. And coming off a significantly oversold condition that Dave referred to, you have to give some respect that the bounce could be a little bit more than we just saw, but the numbers will tell us, and we go with the numbers.
Gotcha. One thing that I like to look at when it comes to the markets, so I like to look at what I call my bow tie setups. And all I'm doing here is I'm looking at a 10-day simple, a 20-day exponential, and a 30-day exponential moving average. And if you pay attention to them on a weekly basis, whenever you have a crossover like this after all-time highs or at least major highs, the market often has a big sell-off. There's no guarantee that it will, but it happened back in 2000. You had one to the upside 2003, downside 2007, 2008, and obviously in 2009 to the upside. So the past 30, 40 years, this has done a pretty good job of keeping you on the right side of the market. My concern last summer was that we did get this bow tie off of all-time highs. And my friend Greg Morris often says whipsaws are frustrating, bear markets are devastating. And he goes on to say that we treat all signals as if they're going to be the big one. And he was running about $5 billion back when he said that, so I certainly respect Greg for that. As far as tops are concerned, when I see a weekly signal like that, that top remains in place until that high is taken out. So I'm not big on drawing a line in the sand, as I think Jim mentioned earlier. But in this particular case, once you have a major signal, if the market goes on to make new highs as a trend follower, then you're obviously wrong. Now, it took a lot of heat for being somewhat cautious during this period. I didn't rush out and short everything like a madman, but I did have a few shorts set up, and we've ridden some shorts down so far in here. Now we're experiencing a little bit of a retrace rally. On a daily chart, you can see pretty serious slide remains in place. What concerns me is usually you don't have this much persistency to the downside, meaning that the market tends to go down day after day after day. And I like to draw a line through the bar. And usually when you see that persistency on the downside, you'll have a pretty big move lower. It's kind of a bit of a Chinese water torture, no pun intended. Speaking of Chinese, it's kind of interesting to see that they were a little spooked over there, at least in Hong Kong, and then human nature never changes. The Hang Seng was down about 30% plus while I was there total over the past few months. And some of the traders there were also, and so they obviously followed it down. It's so funny. You tell people markets go up and markets go down, and they look at you like you pooed your pants, like you ordered a cup of coffee in Starbucks. You went to Starbucks and say, hey, I want a cup of coffee. They look at you like you're crazy, right? But when you tell them it's going down, people refuse to believe you. And I think that a lot of people maybe have drank the Kool-Aid since 2009 that we only go up. And don't get me wrong, I wish this market would only go up because it's much easier to trade a bull market than a bear market. But I think as traders, and if you are going to call yourself a trader, you have to recognize when the market's going up and when the market's going down. I think we could be in a bit of a downtrend. Just real quick, I know we have a lot of people here. Somebody was asking about Amazon. Amazon has made a bow tie down on a daily chart of all-time highs. There's a lot of support just below the market. So I wouldn't rush out and actually short Amazon, but it sure looks like a top remains in place there. And what's concerning is some of these big cap issues are at fairly high levels, and they're propping up the indices, I should say. And I think if they begin to crack in earnest, it could drag down the indices with them. So right now, I think maybe you want to err on the side of being either short, or if you don't go short, just maybe look to lighten up on the long side. And I can't imagine that you have any longs left after this big slide, provided, of course, that you used protective stops. Okay, long-winded answer saying that the market might be in trouble. John, let's go back to you for the question of the week. And the question of the week is, drum roll, please. Do you trade or invest in gold in some form? Do you consider gold an important part of your portfolio? Take it away, John. Have we lost John again? All right, let's go to Dean. Same question, and we'll come back to John.
All right, I'm back.
All right, great.
I'm here. Wow, what a great question. I'm glad I couldn't have teed that up better. And I'm gonna switch my screen share here. Let me see if I can do this. Get it right. Come on. Hangouts is a funky kind of deal.
Yeah, it is.
Okay, let me switch to my chart here. So, the short answer is I trade whatever there's a great setup and I have a high probability of getting profit on. And gold.
Hey, you're stealing my answer.
And so, gold is part of the universe of tradable instruments, right? And if there's a great setup on gold, I'm in. And I saw in the newsletter, I publish a free newsletter on the market. I always, on a weekly basis, I do the indexes, gold and oil. And I've been watching gold for a while. And I said when it got above 1113, that would prove to me that the recovery in gold had started. And that I still say that, and if it stays above 1060, I'm sticking to it. If it goes below it, then I'm just dead wrong. But because I thought that the recovery in gold had started, I started looking at some gold mining stocks. I actually published this one over the weekend. This is McEwen Mining, MUX, and I gave a signal to my subscribers to get in at $1.25. We got in this morning. We're up 8%, and I think it's heading up to at least $1.82. So we'll be 50% profit if I'm right, or more. And again, we always use risk control. My stop's down here at 95 cents. I use a very tight 2% risk control. Never trade without a stop. Right.
Amen.
So that's my deal on gold. Thanks for teeing that up, man.
Yeah. Well, cool. Cool. All right. Did we get John back yet? No, not yet. Let's go back to you, James. Do you trade or invest in gold in some form? Do you consider gold an important part of your portfolio?
I don't. I mean, aside from the couple of coins that I have in a box underneath my bed, I don't really carry too many gold positions. Like I said, our main focus is on usual options activity. So what we're trying to find is big institutional order flow that's going to give us a signal or a hint as to what it is the big players in the market are expecting. And when we talk about commodities, when we talk about indices, it's really difficult to glean any information whatsoever off of that order flow. If I see someone coming in buying a humongous block of calls in the GLD or in the miners ETF or some gold-related name, there's so many different things that they could be using that position to do. They could be using it to hedge a position in physical gold. They could be using it to hedge a position in the underlying stocks. So because of that, it's really difficult for me to kind of look at order flow in commodities and get an idea of where I would want to position myself. And another main thing that kind of keeps me away from putting risk capital into things like that is that one of the big upsides of following order flow is that you occasionally will catch the trader that comes in and buys a giant block of calls ahead of a merger and acquisition announcement or some type of headline that causes the stock to rip to the upside. That isn't really a dynamic that is available in commodities, right? There's not going to be a situation where, silver is doing a hostile takeover of the gold market and, we see gold rip higher by 30% in a day. So since that's such a big kind of, upside potential part of my trading plan, and since that dynamic isn't present in commodities, I don't really focus on them too much, to be honest.
Gotcha. Okay, Jim, let's go to you. Jim Kinney. Do you trade or invest in gold in some form? Do you consider gold an important part of your portfolio?
Well, again, on the Option Professor DVDs, they're educational DVDs just on trading options. They're not any recommendations or specific ideas. Now, obviously, after 30 years of being around this thing, I obviously have watched gold for decades. So, again, my opinion is what it is, and let me give it to you as far as I see it. And again, a lot of stuff could be factored in already, but we all know that those mining shares have tanked to almost a devastating fashion. Yeah. And so there is a disconnect between bullion and the mining shares. Somebody's very wrong or somebody's very right.
Yeah.
And so my view would be that as long as it stays in this window on the upside of 1,300 as a ceiling and 1,000, 1,100 or 1,000 on the downside, we're still in this window, and it's fighting two things that are problematic. It would be nice to have a weak dollar for gold, and it would be nice to have some inflation. And since we don't really have either of those right now that I can see, that's why gold has been a tough racket for the last few years. Now, can those things change? Hey, if we keep getting the 10-year note underneath 2%, and if we even think about going into the Japan idea where we just have negative interest and people have to pay safety deposit money to keep their money stored at B of A, if that's the way the cards come out, then gold would have a situation where it might have an easier chance of running, because that may affect the dollar negatively, like easing has done with the euro and the yen. So if that's the way the news turns, then obviously that could turn these things around quite a bit. But right now I'm just saying we're stuck in this trading range, 1,200, 1,300 on the upside, 1,000, 1,100 on the downside. And could you categorize the mining shares as oversold? I don't think that's a stretch. But again, without those increments of weaker dollar and some inflation, it's hard to get on the bicycle for gold, and that's why gold's kind of meandering between those points I just mentioned.
Yeah, I hope some of those things don't come true because I think we might have to stock up on a little ammunition if that if that does.
Hey,
But
yeah.
let's not go there right now. Um, I like what Dean said. Somebody once said that described me is that if I found out that intravenous drug use was on the rise, I would run out and buy needles. But I don't think I'm that bad unless intravenous drug use is not on the rise, right? But I will trade whatever setting up or whatever is trending. I don't rush out, and I think like James mentioned, other than a few silver coins I've collected over the years, I don't rush out and buy a bunch of gold or silver or anything like that as far as hard bullion. I do pay attention to what's going on in the markets, and I will trade any market. A couple things. Number one, the gold, the commodity itself, as represented by GLD, the ETF, has made a bow tie and recently triggered in here. It's a pretty good looking signal because it's coming off of multi-year lows, and these are the ones, as I said earlier, you want to pay attention to when they're way down here at these multi-year lows. Unfortunately, it's going to have its work cut out for it because as you back the chart further and further out, there's a lot of overhead supply, and my form of technical analysis is nothing magical about it. I'm just looking at the bars to see what trading occurred and where, and that helps me to sort of read the mind of the market. So I know that there's a lot of people who bought gold at much higher levels that might be looking to get out as gold begins to rise. Now, one thing that's kind of interesting, and who did we tee up earlier? Was it Dean or was it Dean with the gold trade? One thing we're seeing now is that we are seeing some of these second-tier mining companies, some of these cheap mining companies begin to rally first off their lows. And the problem with some of those, like I said earlier, it will be the overhead supply. And there is a disconnect, like Jim said, between gold and the stocks. But the stocks are beginning to improve a little bit, but like everything else, they're going to have a little bit of a rough time getting through some of this overhead supply and resistance and such. But I will be keeping an eye on gold stocks in the future to see if we can get some setups in here that don't have a whole lot of overhead supply. And right now, we saw a couple of ones that we had on our radar, such as HMY take off. And again, these are lower level, more speculative issues. So will I trade gold? If it's set up, like Dean said, absolutely. But it has to be set up for me to trade.
Hey, Dave,
Okay.
I wanted to ask you a question real quick on the gold as it compares to oil. You know, one of oil's problems is when it hit $100 a barrel and interest rates were so low, they went out and borrowed all kinds of money and did a whole bunch of drilling and fracking, et cetera, and created a huge supply. I noticed that some of the mining shares that have really gotten whacked also had huge debt that was probably created with the low interest rate environment, and they went out and maybe they went out and found a bunch of gold. Do you think that's a similar factor?
I try not to confuse issue with facts too much. I actually bought those domains. Do not confuse issue with facts, and don't confuse issue with facts. With that said, I think part of the problem with the gold stocks, because I was a pretty big gold bug years ago, I think part of the problem with the gold stocks is a lot of these gold companies sell futures forward because, as you mentioned, they get into so much debt. So they're selling all this gold forward, and they're locking in. They've already locked in whatever profits they may have. So I think that's part of the problem with these stocks. So even if when gold begins to take off, they've already sold that gold forward. I think that's part of the problem. Now again, I try not to confuse the issue with facts too much. So if they start going up again, then I'll be more of a I'll be excited about buying them.
Yeah.
Okay. I think we lost John for good, but we appreciate him coming anyway. Dean, let's go back to you. Any closing thoughts or anything you want to add before we close down here? Anything else you want to tell us about FollowMeTrades.com or your own trading or the markets? The floor is yours.
Okay, yeah. So this is that gold trade, and you know, you guys mentioned coins. That's funny. You know, I keep seeing on your late night cable, you hear it on satellite radio. The guys selling bullion, selling coins, selling gold IRA. Somebody tell me what's special about a gold IRA, please. You know, you can buy a precious metals mutual fund, or you can buy GLD or individual stocks. So yeah, you don't need to hide it under the bed, man. It trades on the market. Yeah, I'll show one more trade. You know, when the market, you know, on December 19th, I said, hey, I see the pattern setting up where we're going to head back down pretty sharply, and we did. Man, we were short Apple, Goldman Sachs, Abbott Labs, United Technologies, and those are pretty stunning trades, man. I wish it moved like that more often. We did really well. You know, we trade those primarily with put options. I don't like going short directly. But here's a long trade we're taking. This is ELLI, Ellie Mae. It's a mortgage processor. And so as the market's fallen, this thing's going up, man. It has a great Elliott Wave 5 setup, and we're long this. We're in at 66.57. Got our stop down here, right? Again, I never trade without stop. I use risk control. Never lose more than 2% on any given trade. And then we're ready to take our first scale, take a little profit off this one. And again, I love options. We're trading this with a call option. It's a higher price stock, and let this baby run. So there's a couple trades, you know, that we're publishing that if folks are interested. It's ELLI we're long, and MUX, you know, low price gold mining stock that we're long at the price levels there.
Cool.
And you know, that's kind of how we do it. Look for good setups. I don't know about, you know, intravenous drugs, but you know. You know, you know, I look at sectors, I look at the broad trend on the indexes and try and figure out, you know, what's going on, and then go find individual charts. What was your phrase, Dave, about the facts? I love it.
Yeah, don't confuse issue with facts, and do not confuse issue with facts.
So I'm a news junkie, and I listen to the news and take it all in.
Yeah.
All of my trading decisions. And I think it's good to know that big events are coming up and there may be some volatility and maybe you need to watch your stuff a little closer, move your stops or whatever. But every decision I make is, you know, the reality of the chart. Price and volume are the only realities, right? The rest is all noise. It's all noise. It's fun noise. It's fun noise. You know, it's interesting. You know, I could get into the presidential race too, but I'll stick to trading on this show. But it, you know,
I ignore all this, and even I'm getting sucked into that. Boy, I tell you.
It's interesting. It does affect the markets, but all my decisions are going to be made based on the realities in front of me on a chart, and that's how we do it, man. That's how we do it. All right, it's great to be here. Thanks.
Yeah, they're one of the complaints about the show is not enough controversy. It doesn't look like we're going to have much this week either. James, let's go to you. Anything else you want to tell us?
We all disagreed. We all disagreed with the crowd sentiment.
Oh, no, we all agreed.
We all agreed it's going down, and the crowd sentiment said it's going up. So.
Oh, okay. All right. Well,
David Kosmiter's report said it's going up. So.
Oh, okay. All right. Well, maybe it is a little controversy. James, let's go to you. Any closing thoughts? Anything you want to tell us or add about alphashark.com?
Yeah, so thank you very much there, Dave. Like I said, our main focus is trading unusual options activity. So for those of you that are options traders out there, if you haven't heard of unusual options activity before or are unfamiliar with it as a concept, I highly recommend you check out what it is that we do here at AlphaShark. If any of you would like to trial our services or check something out, feel free to shoot me an email, james@alphashark.com. Trading unusual option activity and order flow is a completely different way of looking at options trading and looking at the options market than you are probably used to. So if you're at all interested in unusual options activity as an idea, or at all interested in trading earnings and catalyst events using equity option spreads, please drop me a line and I'll be happy to share some more about what it is that we do here and how you can get involved and become part of the community. We have over 1,100 members that actively partake in our various services and subscriptions. So it's a big community, a lot of people, a lot of ideas bouncing around on a daily basis, something that is really interesting for you if you are an options trader looking to learn more.
Cool. All right, Jim Kenny, you're up next. Anything else you want to tell us about your trading, the markets, or optionprofessor.com? Floor's yours.
Okay, well, with regards to optionprofessor.com, obviously, as we stated, we have the DVDs for educational purposes only, and it does give you a pretty thorough look at all the different strategies that are out there that we cover. So there's value there to most investors out there. With regards to just my own comment here is that, as many people have said here, we've had a pretty significant drop off those highs of 2135 on the S&P, so some might categorize that as the market has broken. Now the key is will we get a bounce back rally, which we saw a little bit last week, and how far it'll go. You know, if we go up to 1950 or 2000 area, which might surprise some people, and then it stalls up there, strategies such as the collars or the married puts, which are hedging type strategies, which are covered on the Option Professor videos, might come in very handy, particularly for people who might not want to sell out of positions, but certainly wouldn't mind some portfolio insurance. So that would be a real value-added thing to know about. If we do get a little further bounce back off of that oversold condition, that'd be something to have in your arsenal if you were going to, try to protect some of these because we don't know if it rolls over further, if it's going to be like these people who've been saving so much. Is it just they're saving for a rainy day? That's why it's up 3% on savings in the fourth quarter. Or is Katrina coming? And we don't know that. So having strategies that can be an umbrella to some of the stuff you're holding longer term, like married puts and collars might be in certain circumstances, could add some value. So I just suggest people investigate that kind of thing.
Oh, okay. Well, I'm just outside of New Orleans, so I hope it's not another Katrina. Believe me, I know a lot about that. One thing I didn't mention earlier is, just for sake of time, but every day I look at about 2,000 to 3,000 stocks, and of that, probably about 200 sectors or more, and then obviously the major indices. And one thing I've been seeing internally for a long, long time is a lot of stocks have been headed lower, and mostly small caps sort of started out headed lower, and then now we're beginning to see some of these big cap issues begin to implode a little bit. So it's pretty scary out there, and you really, a lot of times I do all this analysis, and then I look at the Russell 2000, I'm amazed at how it so greatly mirrors what I'm seeing internally. And I have a YouTube channel, youtube.com/C for custom/Dave Landry, and you can watch some videos. I have about a little bit over 1,500 videos out there, and I do a daily market in a minute, so you can check that out. I talked about the Russell this morning. Again, DaveLandry.com. We're educationally based website. I have a newsletter, free newsletter out there if you're interested in that. Also, I do a weekly webinar where I'll talk a little bit about what I'm seeing in the markets, maybe lecture a little bit about psychology, money management, some of the things that we've talked about here today. And then we'll take a look at your stock picks, and we'll take a look at the market and where I'm finding opportunities. And those shows are free. You can sign up on my website. Also, I have a stock picking service would be a good way of putting it, where I take all my daily analysis after looking at all these charts, and I condense it into about a 4 or 5 minute video, and I publish that daily. And you can get a delayed version of that if you're interested, and follow along and see what I predicted a week or so ago and see what actually came true. And I think it's a great way to learn for free. Anyway, I think that pretty much sums it up. Again, my email is dave@davelandry.com. I do answer all my emails, I should say, eventually. Obviously, clients get precedence to me, but I will answer your personal emails, and I'll answer them personally. Anyway, I'll let David Cosmeter close down the show. We lost John Netto of theproteintrader.com, but John's a good guy, and I'm sorry that he had some technical difficulties there that knocked him off. David, you want to go ahead and close this up? And thanks again to you for having me back as host.
Yeah, thanks, guys. Great show. I've been trying to deal with some technical issues. For some reason, no one is able to watch the show, but everything looks correct on my end, so I'm pretty sure it's still recording. So I'm going to have to get the link out to everyone who tried to watch today. But so yeah, thanks everyone for being here. Just want to just remind everyone. You can go to TimingResearch.com/reports to get this or any past reports. And I just want to thank my guests again, John Netto of TimingResearch.com, Dean Jenkins of FollowMeTrades.com, James Ramelli of AlphaShark.com, Jim Kenny of OptionProfessor.com, and of course Dave Landry of DaveLandry.com. Thanks for hosting again.
Thank you.
All right.
All right. Thanks again, everybody.
Thanks, guys.